Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Okay, so this deep dive is based on our research from October 24th, 2025. We're taking a close look at D-Wave Quantum. The ticker is QBTS.
Right, and our job today is really to unpack this situation. There's all this buzz about D-Wave, especially this idea of a potential government lifeline for quantum computing firms. Is it a golden ticket? Or, maybe just a gilded cage?
Exactly. It feels like a major battleground stock right now. You've got this powerful speculative news hitting up against some pretty stark technical realities on the chart.
Definitely. And before we get into the nitty-gritty of the chart, it's worth noting the broader market context. Things are generally green, the NASDAQ Q's leading, and there's this narrative, right, that AI investment is booming and maybe keeping the U.S. out of a recession. That optimism helps fuel stocks like D-Wave.
Yeah. That makes sense. So D-Wave, they build these incredibly complex quantum computers, futuristic stuff. And the big recent move, that was all about those reports, wasn't it? That the US government might take equity stakes in key quantum companies to keep up globally.
That was the catalyst, yeah. Pure speculation, really. It sent the stock flying.
Even though the Commerce Department kind of walked it back a bit later.
They did, they clarified, but the market had already reacted. The initial energy was there.
And what's wild is the Wall Street view. We're looking at, 10 analysts covering it?
All 10. And every single one has a buy or strong buy rating. Unanimous.
Wow. And the consensus fair value are around $34.25. That seems pretty bullish given the actual business.
And it is extremely bullish. And that's the core conflict here. The faith, if you will, it's all tied to this government potential, not actual revenue or profits. It's become almost a political trade, totally detached from the balance sheet fundamentals.
Right, because this is a super cash-intensive industry, isn't it? Profitability seems miles away.
Oh, absolutely. Highly speculative, burning cash. Profitability is a very distant dream right now.
Okay, so Wall Street's betting on hope, basically. Let's pivot to the fear side then. The sentiment, the technicals. What's the chart telling us after all that volatility?
Well, sentiment is really split. On one hand, the options market looks pretty bullish. The put-to-call ratio is down at 0.88.
So more calls being bought than puts, betting on a rise.
Yeah, significantly more calls. They seem to be targeting that $40 strike price, almost like a magnet pulling the price up.
But then you've got the shorts.
Ah, yes. The counter argument. A really hefty 16.88% of the available shares are sold short.
16.88%? That's huge. That creates massive tension.
Massive. It sets up a potential powder keg. If that government funding story gets legs or firms up, you could see an absolutely violent short squeeze. Very fast.
And the price action reflects this fight. It ran up past $40, then cratered.
Exactly. Spectacular run, then a hard plunge below $30, and only clawed back to around the $33 level because of that after-hours pop on the government news.
So the bounce wasn't really organic buying.
Not primarily, no. And this is why the technical damage is a big concern. Short-term indicators. They're basically screaming that a reversal happened. The upward structure looks broken.
You mentioned distribution during the collapse in your notes. Can you explain that for listeners? Who was selling?
Good question. Distribution in this context means we saw signs of large institutional selling. Money flow indicators tracked where the volume was going. And during that price collapse, it suggests that big blocks of shares were being sold, perhaps quietly liquidated by institutional holders.
So the bigger players were heading for the exits while maybe retail investors were trying to buy the dip.
That's what the pattern often suggests, yeah. Catching a falling knife, as they say.
Okay, that's a pretty serious warning sign. If the big money was selling, what happened to the momentum, that powerful upward thrust it had?
It just evaporated, gone. Momentum indicators stalled out and crossed firmly into bearish territory. And the volatility is still extremely high, which usually tells you that the explosive part of the upward move is likely over.
High volume selling, broken momentum. Sounds like sellers took control.
That's the takeaway, yes. Sellers appear to have gained the upper hand, at least for the immediate term.
All right, so putting it all together, the Wall Street hype, the government speculation versus this institutional selling and technical damage. What's the strategic verdict?
We're landing on neutral, but definitely with a bearish bias. That technical damage, the high volume selling, it makes that news-driven pop look like, well, maybe just a temporary sugar rush.
But there are risks to being bearish here.
Oh, absolutely. Huge risks. That government funding could turn out to be real and substantial. That 16.88% short interest means a squeeze is always possible, and it could be brutal. And you just can't ignore 10 out of 10 analysts screaming buy. That's a powerful consensus, even if it feels disconnected from fundamentals right now.
So what are the key levels to watch now? Where's the battle line drawn?
Okay, for the bulls, they absolutely need to get price back above $33.50 and hold it. A decisive close above there opens the door to maybe challenge $40 again.
And for the bears?
Bears need to push it back below $32 support. If they manage that, then retesting those recent lows around $29.66 looks very much back on the table.
And what would make you change that bearish bias?
A solid close above $34, especially if it comes with strong buying volume. That would signal the bulls have wrestled back control and invalidate the immediate bearish outlook.
Got it. So D-Wave, it really is a classic battle stock, isn't it? Compelling story, lots of political intrigue, versus a chart that looks, well, pretty banged up from recent selling by big players. You should definitely be prepared for some extreme volatility in the coming sessions as this whole thing plays out. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.